This video is brought to you by Nebula and TLDR's Race Across Europe. At the height of the Truss era, there was quite a lot of discussion about whether Britain was heading headfirst into a full-blown housing crisis. In fact, we did an entire video on it. It was only after she installed Jeremy Hunt as Chancellor and promptly reversed the vast majority of her mini-budget measures that the British economy, and by extension the British housing market, could breathe a sigh of relief. Unfortunately for ordinary home-owning Brits, alarm bells are ringing across the housing sector once again, and this time there doesn't seem to be an easy fix. Before we start, if you haven't already, please consider subscribing and ringing the bell to stay in the loop and be notified when we release new videos. For regular viewers of our videos, you may have noticed that we actually did a video on a potential housing market crash as recently as last month. But a lot of new and unexpected data has come out that has forced us to come back to the table, and not because a crash is less likely. Anyway, to properly understand why the UK housing market is a ticking time bomb, we need to quickly run through how home purchases in the UK generally work. Very few people have the necessary cash on hand to buy properties outright. Most people have to borrow money from a bank in the form of a mortgage. These mortgages will, more often than not, be split into two periods with different interest rates. First, a period where rates are fixed, and then a period where rates generally track the Bank of England's base rate plus a certain percentage, known as standard variable or tracker rates. Generally, when fixes run out, you remortgage onto a new fix. In any case, figures from the Bank of England show that mortgage borrowing fell sharply in April to its lowest level since records began in 1993. April saw consumers repaying £1.4 billion more than was issued in new lending. In other words, the mortgage sector shrank. Nationwide, a major UK lender, recorded in May the sharpest fall in house prices since the financial crisis, with house prices falling at an annual rate of 3.4%. And according to analysis by Bloomberg Economics, home values have already fallen more than 10% from their nominal peak back in August. Halifax, yet another major UK lender, recorded the first annual fall in UK house prices since December 2012. So why are house prices falling? Well, in short, inflation. Whilst inflation as a whole is falling, core inflation is not. Core inflation is the bit of the inflation figures that strips out the most volatile seasonal changes in prices and is used to give an indication of the underlying inflationary pressures in the economy. It's, at heart, the part of the consumer price inflation that is expected to persist into the medium or longer term. And it's staying stubbornly high, which is worrying policymakers at the Bank of England. They're concerned that inflation is at risk of being, or already is, entrenched in the economy, and this runs the risk of a wage price spiral. In other words, if workers think inflation is going to last and be significantly higher over the next year or so, they'll demand a wage increase that takes that into account, which means more money chasing the same amounts of goods, which creates more inflation and so on. To cool down the economy, the Bank of England has been aggressively increasing interest rates for a while, but inflation just isn't falling as quickly as they would have hoped, which means more interest rate hikes will be needed. This is why gilts, i.e. short-term UK government bonds, have recently seen their yields spike to levels even higher than those seen post-mini-budget, as investors anticipate further rate hikes. As Nick McPherson, the former permanent secretary to the Treasury, wrote on Twitter on Tuesday, it's now much more likely that the Bank of England will raise rates to a level where a recession next year becomes inevitable. Most homeowners have been relatively sheltered from the interest rate hikes because most people fixed the interest rates on their mortgage for a given period, typically 2, 3 or 5 years. And, well, if you fixed your mortgage rate 2 years ago, you would have been doing so at a time when the Bank of England's base rate was just 0.1%. By comparison, today it stands at 4.5%, with it widely expected to climb even further in the next few months. This is particularly problematic when you consider the state the housing market was in back in 2021. As the UK came out of the first COVID lockdown, the government introduced a stamp duty holiday to encourage house buying. Anyone buying during the stamp duty holiday will, more than likely, have opted for a 2-year fix, which will expire this year, with most coming to an end between July and October. Analysis by MoneyFacts found that the average 2-year fixed-rate mortgage on the market last Thursday was 5.82%, up from 5.49% from the start of June. The average 5-year fix was 5.49%, up from 5.17%. To put things into perspective, if you were to get or refinance a £300,000 mortgage at last Thursday's rates, you'd be paying roughly £650 a month more than 2 years ago. And that assumes that you can actually get a new deal. Last Thursday, HSBC told mortgage brokers that it would pull all new deals within a matter of hours, though it later U-turned after criticism from brokers. This itself came after banks and building societies in the UK pulled almost 800 mortgage deals over concerns about future interest rate rises. These much higher rates are depressing the housing market, as seen with the recent falls in house prices. The fact that house prices are falling and interest rates are sky high means that potential home buyers are putting off their purchases in the hope that prices will continue to fall. And that's before we even come on to the issue of people potentially defaulting on their mortgages, which could put a strain on the wider financial system. Now, at this point, our median viewer probably wants a housing crash. But we should warn you, if you think a potential housing crash is good news for renters, think again. Hikes in the cost of mortgages filter through into the rental market for the simple fact that many landlords have so-called buy-to-let mortgages, which are also seeing repayments rise, which is one of the reasons the rental market in the UK has been so mental recently. As a final thing, this is terrible news for Rishi Sunak, who promised to get inflation down as one of his 5 priorities. Not only is core inflation still ticking up, but it's also feeding into mortgage costs, which are going to financially cripple the millions of Brits that own their own homes. In fact, it's such bad news that there's been some speculation that he might even call an early election before the mortgage rate crisis peaks. There's also some other huge news, by the way. We've just launched our new series, TLDR's Race Across Europe. Take a look.
Go, Dan, go, go, go.
He's off.
He's off.
He's gone.
Dan's going.
I hate
and
this.
so are we.
I hate this.
Oh no! Oh, it's harsh to my vibe, so hard. This is the worst thing that could have happened.
Well, Jack is definitely lost. There's no other way.
Guys, it's not looking good. What? What do you mean? What do you mean? We've come through some kind of police barricade. I'm afraid she's dead. I don't know where this Jeremy.
Look at those geese.
It goes so fast. Oh, I know.
Now, you can watch the first episode on the TLDR EU channel right now. But we're also releasing every subsequent episode a week early on Nebula. So if you're a Nebula subscriber, you can watch the first 2 episodes right now, totally ad-free. That's true of all TLDR content, by the way. We regularly release our videos on Nebula before they come to YouTube, and everything's ad-free, so not even this advert is here. It's not just the race either. Every week, TLDR produces well over an hour's worth of content, which is exclusively for Nebula. That's exclusive discussions where our team share their thoughts on the latest stories, extended daily briefings, our Nebula series This Week in Parliament, and even full explainers. So if you want the full TLDR experience, you really ought to be on Nebula. Sign up now using our link in the description to get everything the platform has to offer for just £2 a month.